Today we're going to talk about a technique that combines getting rid of your garbage stocks and bringing your tax bill closer to zero. 2021 has been a very interesting year. The stock market was skyrocketing at the beginning of this year. However, later on in this year, all these growth in tech stocks and small cap stocks have come tumbling down. Some of these stocks have dropped 50, 60, even 70%. Now, if you're holding any of these in your portfolio, you must be thinking, dang, why did I invest in them? Why did I listen to that Motley Fool article who said that this stock could 2x next year? But it's not like you have a time machine and you can go back in time and undo that investment. So what do you do right now with that losing investment? Well, today we're going to be talking about tax loss harvesting. And this is a method that you can use to offset the gains that you made earlier on in the year. I'll explain to you how tax loss harvesting works, give you an example, as well as tell you 4 different rules you must follow in order not to screw up this process. If you're new here, my name is Daniel, and here on this channel, we talk about stock market investing. And I've been doing this for about 2 years right now, and I focus on Canadian stock market investing. With that said, let's roll the intro. So if you've never heard of tax loss harvesting, what you're doing essentially is selling off some loser stocks in your portfolio that you want to get rid of and using these losses to offset gains that you made earlier on in the year from those successful investments. So in 2021, you might have had some banger growth stocks at the beginning of this year where you made 2, 3, or even 4x your money on these positions. But then you took those gains and reinvested it back into other hot stocks that you thought were going to go up. But the market has been bleeding heavily, and you realized you don't want to hold on to these stocks anymore, and maybe you want to change your strategy. It does suck to sell off your position at a loss. However, what you're doing right now if you sell before December 31st is your tax loss harvesting. Because the stock that you sell at a loss, you can take those losses and offset your gain. So for example, let's say you bought Shopify stock, you bought $300 worth because you have fractional shares on Wealthsimple Trade. And Shopify skyrocketed and you doubled your money from $300 to $600. Then you took those $600 and you invested in a small cap penny stock like Drone Delivery Canada, and you lost $200 currently on your position. So now your account is worth $400, but you haven't yet sold Drone Delivery Canada. So right now you're kind of sitting there looking at your portfolio and saying, I have a $300 gain here. And currently I'm down $200. But I really don't want to hold Drone Delivery Canada. So what you do to tax loss harvest is you sell off Drone Delivery Canada and you take that $200 hit. So you've got a positive $300 gain and you lost $200 on Drone Delivery Canada because you decided to sell it. And in the end, you only have a net gain of $100, which you end up paying taxes on next year. So it wasn't all doom and gloom holding on to Drone Delivery Canada. At least you got to offset your gains that you made early on in the year. So essentially, let's say your tax bracket was 30%. Originally, if you didn't sell off Drone Delivery Canada and kept on holding it till next year, you would have to pay capital gains tax on $300 worth. 50% of the gains are taxable. So of the $300, $150 is taxable. And you get taxed at a 30% tax rate. That means you're paying about $45 in tax. However, if you sold off Drone Delivery Canada and you reduce your total capital gains for the year to $100, then you only owe tax on 50% of the $100, which is $50. And if you're taxed at 30% on $50, that means you're paying a total of $15 in tax. So if you compare the difference between the two scenarios here, either you're paying $45 in tax or $15 in tax. So essentially you pay 1/3 less if you tax loss harvest if you were in this situation. Now we're going to go over the 4 rules you must follow in order to utilize tax loss harvesting. If you don't follow these 4 rules, you might find yourself in trouble or realizing that you didn't do it properly and you have to pay more taxes than you thought you would have. The first big rule is that you only can tax loss harvest in a taxable account. For most of you watching this video, it would be a cash account or a non-registered account. Accounts like TFSAs and RRSPs, you cannot tax loss harvest from. For this reason, a lot of investors tend to do safer stocks in their TFSA as well as RRSP. Because if you go all in on a penny stock and you lose all your money or you lose 90% of your money, then you can never gain back that contribution room. Let's say you invested $5,000 into a penny stock thinking that it's going to shoot to the moon. However, the penny stock ends up dipping and you're left with a $100 position. You've lost $4,900 and you can never actually gain this contribution room back. It's not like you can deposit another $4,900 to make back your original $5,000 contribution. This is lost forever. And that's why most people tend to invest in penny stocks or super high growth stocks in their non-registered accounts. Some of these stocks you might have a 10x growth on, but the other ones you might completely lose all your money. And if you lose all your money on those stocks, at least you can tax loss harvest and offset the gains that you had for that year. Another great thing about capital losses is that you can carry them forward indefinitely. So let's say you stop investing for the next 19 years and 20 years later you start investing and you have a crazy good year and you have a gain of $10,000. Well, you're able to take the loss of $5,000 20 years ago and apply it to your current capital gains and offset it. That would mean for the year that you actually had capital gains of $10,000, you would offset it with the $5,000 capital loss you had 20 years ago, netting you a $5,000 capital gain, which you pay tax on. The second rule you must follow in order to not have CRA come after you is that you can't buy back the stock within 30 days. So in the example that I gave earlier where you had a gain of $300 on Shopify, if you sold off Drone Delivery Canada on December 1st and decided to buy it back because you liked it again on December 15th, well, the $200 loss that you got from Drone Delivery Canada cannot be applied to the Shopify gain of $300. In fact, it just doesn't count at all. So be careful when you're tax loss harvesting. Remember, you cannot buy back the position within 30 days. On top of this, you cannot buy back the stock in your spouse's account or any other business account that you hold. So you're not able to sell off Drone Delivery Canada in your taxable account and decide to buy some back in your TFSA. That doesn't work at all. That will just have the CRA knocking at your door for an extra taxable income of $200. The third rule is similar to what we were just talking about earlier, but there's a bit of a twist, and I think a lot of people fall into this trap. I myself have thought about it too, but realize I'm not able to do this. This technique that's often employed by retail investors is by shifting a stock from a taxable account into your TFSA or RRSP. When you're shifting it from a taxable account to a TFSA and you're down on that position, essentially you're hoping to sell that stock at a loss and shift it into TFSA and hope that next year the stock goes back up. However, that violates the rule of buying back a stock within 30 days. The final rule that we're going to talk about here is that the stock that you're tax loss harvesting must be sold in the calendar year, not by April 15th, which is when taxes are due. So you must sell it before December 31st. Otherwise, the capital loss that you sold on January 1st or January 2nd will count for the next year. So to recap the 4 rules. The first rule is you have to sell your stock in a taxable account. The second rule is you can't buy back the stock within 30 days. Your spouse can't buy it back, and you can't buy it back in another account, including a TFSA or RSP or even RESP. The third rule is that you can't shift a losing stock from your taxable account into your TFSA or RSP and claim capital losses. And lastly, rule number 4 is that the stock must be sold within the calendar year on or before December 31st. If you sell a losing position on January 1st, 2022, then you can only file for that capital loss next tax season. I'll give you another tidbit that you might not have known about. So let's say you've been investing for 4 years. In the past 3 years, you've had a total capital gain of $10,000. However, in 2021, you lost $4,000. You're able to actually apply this $4,000 capital loss 3 years backwards. So for the $10,000 total capital gains that you had in the past 3 years, you can offset those capital gains with your current capital loss of $4,000. So in a way, you actually would be claiming back money from years prior where you had capital gains. So likely, instead of you not getting any money from the government and suffering that $4,000 capital loss, by applying this $4,000 loss on the previous 3 years of capital gains, you'd actually be able to claim back taxes for $4,000 worth. So if your tax bracket is 30%, you can claim back $600. So that's all you need to know about tax loss harvesting. If you've been on the sideline about investing, but tax loss harvesting has made it a bit easier for you to jump in, well, you can use my code down below and sign up for Wealthsimple Trade today. It's a completely free platform to start investing, and you'll get $50 when signing up through my link, depositing $150 and investing that. If you have any questions about tax loss harvesting, leave them down below and I'll try to answer as many as I can. I've got a couple videos up on the screen here. If you're interested in those, you can check them out. If you're there, I'll see you there. If not, keep up the grind and have a great day.